Do you know why billionaire Elliot Singer and his feared hedge fund, Elliott Investment Management, invested $1 billion in a slow-growing, boring auto parts company? You might think it's for the dividend, which has been raised every year for 69 years straight, or that he's betting against electric cars. But you would be completely wrong. In September, the company, via a press release, revealed that Paul Singer had bought their stock. And the deal also included 2 board seats. If this investment fails, Singer won't just lose hundreds of millions of dollars, it will also hurt his reputation as the most feared investor on Wall Street. So, what was the crazy reason that made him invest $1 billion on this boring company? In this video, I show you what Paul Singer saw, what it's worth, and why I also started investing in the company. Before we go over the company and the problems, I show you what happened after the press release. First, 2 new board members handpicked by Paul Singer joined the company. Then just 5 months later, the company shocked everyone. They announced they are splitting this 100-year-old giant into 2 completely separate businesses. But right after the news, their stock price crashed. This didn't happen because of the news about the split. It happened because they lost a lot of money. Low profits, they made 50% less money than experts expected. Shrinking margins, they spent too much money to run the business, which hurt their profits. A bad future that warned everyone that 2026 would be a very slow, tough year. They also had hidden bills. They had to pay a massive $825 million in surprise bills. This included supplier going broke, employee retirement payouts, and expensive lawsuits over old asbestos parts. All of this bad news scared investors, and the company lost almost $3 billion in value in just one day. But as you can see, the stock price recently jumped back up. This because a rival car parts company, O'Reilly, has reportedly made a massive bid to buy NAPA, which is Genuine Car Parts Division. Insiders are talking about a deal worth $10 billion or more. While making this video, NAPA's parent company has not made any official statement. But the rumor alone has sent the stock soaring, showing that investors are excited. Genuine Parts Company has 2 divisions. Its largest business is NAPA, which creates almost 2/3 of the sales. A global car parts retailer with about 6,000 stores across North America, Europe, Australia. NAPA sells parts repairs and serves professional mechanics 80% of the sales through frequent deliveries to repair shops, while individual drivers like you and me account for the remaining 20%. This makes GPC part of the largest automotive parts network in the world. NAPA sells car parts, but their parent company also owns a second business called Motion. Motion has over 700 shops across North America and Australia. They sell parts that factories need to run, like belts, hoses, and gears. Motion has over 700 shops, which only makes about 1/3 of the total sale. So what is the problem? First of all, the company stock was underperforming the S&P 500. I started comparing from 2015. $100 invested in the S&P 500 would have given you almost $290, while investing in GPC would have given you only $46. Competitors like O'Reilly, who were supposed to bid on the auto part division of GPC, beat everyone, returning $600. AutoZone gave you $433 in the same period. Then you have others like LKQ and Advanced Auto Parts, who are on the bottom right along with GPC. When we compare it to Motion's competitors, we see how the company got crushed. Competitors like Applied Industrial Technologies would have created more than $600 in the same period. W. Granger, almost $480, and Fastenal Company $370. So GPC stock get crushed in both industries. When we are looking at the growth rate, we see over the last 5 years, GPC sells more each year. That is good, right? But GPC keeps very little of the money. From every $1 of sales, only 6 cents is left after cost and equipment. Most similar companies keep 10 to 20 cents. The money GPC keeps is also shrinking. In 2022, it kept about 7 cents per dollar. Now it's about 5 cents. GPC also had special costs, restructuring, in 3 of the last 6 years. That happens too often to call it one-time costs. Bottom line, sales grow fine. The problem is low profit that keeps getting lower. But there's also a third huge problem growing: electric cars. First, an electric car has way less parts to replace than a regular car. Second, and this one is worse, the EV brands want to do the repair themselves. When a car like Tesla breaks, it doesn't go to a regular repair shop who buys its parts at NAPA. No, it will go to one of Tesla's service centers. Sometimes it's just a software update. This means less product sales for NAPA because the small independent mechanic gets cut out completely. As our numbers showed, just 6 cents kept per sales dollar. In my opinion, GPC has no real competitive advantage. Motion only has a weak competitive advantage because customers can leave Motion if they want. It just takes some effort, unlike Honeywell Aerospace, which we analyzed before, where customers are locked in for decades. So, what is the game plan of Elliot? Although he didn't release a presentation like they did with Honeywell or Pepsi Company, we can see a bit of his game plan through the directors he picked. For NAPA retail stores, Paul Singer chose Mav Carey, who led the team that made shopping at the Home Depot easy and fast. Because he is an expert at this, he can help NAPA use the same smart technology to make sure you get the right car parts exactly when you need them. For the other part, Motion Elliott Management brought in Kurt Reuters, if I pronounce it well. He previously held executive roles at Granger, the biggest competitor to this side of the business. So he knows exactly what he's up against. He's an expert at moving parts from factory to the users, and he knows how to make that happen faster and cheaper. To see why Elliot invested in the company, we need to go into the numbers. Quick note before we go into the numbers: this is educational, not financial advice. Investing carries risk, and you can lose your money, even all of it. NAPA earns about $1.2 billion in EBITDA. Genuine Parts makes about 7 cents on every dollar of sales. Its competitors, AutoZone and O'Reilly, around 20 cents. Cap has his reasons. Part of it is just how the company is set up. Most stores are running by local people, so they keep the profit and not the company. The normal situation, I'm not even giving NAPA a peer multiple, I'm marking it down for the margin problem. 12.5 times EBITDA, that's 15 billion. Best situation, margins go from 7% toward 10%. EBITDA grows, the multiple re-rates, and with 17 times EBITDA, that's 20 billion. Now, according to Bloomberg, O'Reilly made a cash bid for this part of business. The amount never disclosed, but sources put the value around $10 billion. As of me making this video now, the company has not given a reaction. But when we calculate it, the offer is around 8.3 times EBITDA. That's much lower than it trades now and what I used. If it's true, the $10 billion, I hope Genuine Parts would not accept the offer. Now Motion. Motion earns about $1.15 billion in EBITDA, and unlike NAPA, the margin is rising 12.9% up from 12.6%. Granger trades at 16 times EBITDA with a 15% margin, while its competitors are priced even higher. Fastenal, the king, 23 times with 22% margin. Applied Industrial, 18 times with a 12% margin. Did you see it? Applied is Motion's twin. Almost the same margin, and the market pays 18 times for it. For the normal case, I took 16 times. That's 18.5 billion. Best case, Motion re-rates to 19 times. That's 22 billion. Put it together. Base case, about $33 billion, and best case, $42 billion. But we are not done. Two things still come off the top. First, headquarters cost about 350 million a year. Capitalize that, and I took 5 billion off. Second, the debt. Straight from the balance sheet of quarter one of 2026, there we see they have 5 billion of total debt minus a half billion of cash. Netto debt is 4.5 billion. Now we get 24 billion to 32.5 billion of equity. Divided by 138 million shares. Normal case, we get $174 per share, and in better case, it's around $236 per share. The stock trades at $125 today. From here, the base case is 39% higher, better case, 89%. On average, I paid $116 per share. Before I go over why Elliot bought the shares and I also started to invest in this company, let's talk about the free cash flow. This year, the company expects to have $550 to $700 million in free cash flow. Compared to what the whole company cost, about $17 billion, that's only 3 to 4%, so that's really low. And here's something to think about. What needs also be subtracted is the company pays its bosses about $50 million a year in extra shares. So what is the risk? First, the split never happens, or it comes much later than expected. Second, they don't fix the margins before the split. And third, the big one, electric cars, if you ask me, EVs are a real threat to NAPA company. What are insiders and Wall Street doing? Currently, we need to wait on the news from the company about the compensation, who goes where, and who owns what of the insiders. And I went over holdings of different investors. You can see that Seth Klarman also bought the shares of the company in Q3 2025. So here's my take. I think there's a big upside if the split happens. And hopefully the company will bring more details about the split and that, etc. in a few months. That's why my plan is simple. I'm here for the gap, the difference between what the market pays today and what the parts are worth apart. After the split, I probably will sell the shares of both companies once that gap closes. And maybe I will keep Motion if it can grow faster. So why did Paul Singer invested $1 billion in this company? In my opinion, he thinks he can fix the low margins of NAPA so that more money stays in the company from the sales. And the other thing is that he knows that Motion has more value when it's trading on its own compared with his competitors. And Motion has also a big secret. It's recession proof. Why? Because 80% of its sales come from repair and maintenance parts, which are needed for companies to keep their machines running. And this is, of course, needed in any economy. That's it. If this video was helpful, just let me know in the comments.